Today we're going to talk about the 6 key ingredients to trading success. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Almost at the end of the week. We've had some fantastic trades this week. A couple of markets that have been quiet a few days and moved on others. We've had lots of great feedback, lots of great questions, and again, trying to get through and answer as much as I can, juggling everything and keeping focused on trading. Today we're going to talk about the 6 key ingredients to trading success. And we could probably add a 7th one in there, but we'll expand on that one in number 6. We go over our simple 50 pips a day trading system. Now, I've had some comments in the last few days, one in particular that called this approach to the markets science fiction. So again, coming back, this is about markets in general. They cluster the volume inside and they hit the stops. They hit the stops. Build more volume up, trap it inside, and hit the stops. Whether that's a trending market, we can have a stop hunt against a trend. We can have a stop hunt false break. We can have a stop hunt in a trading range. But generally speaking, the stops get hit. So whenever we work from the high and low of the day. We talk about structure, reviewing the highs and lows of the bigger geometrical patterns, looking to see if there's any compression built up for a bigger asymmetrical move, risk reward wise. So we may be in a geometrical pattern that instead of giving us 50 pips may have a 150 pip move. And if we're trading on that particular day and we're aware of that pattern possibility, we want to be able to capture as much from a move as possible. We work from the high and the low of the day. We're going to be going through some examples afterwards, just looking at, regardless of how the setup is, we work from the high and the low of the day, and that will help us filter out less than optimal trade setups because they're jamming them in from high to low. It's a 25 pip box, no real ideal setup. Or we can look at other markets where we've got a high and a low and they break out, as we saw yesterday on the pound Aussie, pound New Zealand. They hit the highs, they reverse it prior to the 12 candle window, stop hunt back inside of the box, consolidate, and give a 50 pip move in the other direction. So you're starting to build your playbook. You're starting to see some of the same setups showing up over and over again. Jamming people in down low for the buy, jamming people in up top for the sell, clustering the volume, hitting the stops, shifting the market again. We talk about the importance of the timings. That 12 candle window ideally is either going to be the stop hunt, the trap, and the trade, or as we saw yesterday, they may have already hit the stops, pulled it back, trapped people chasing the move in the wrong direction, consolidated it, and reversed the market. But we talk about 3 things that markets do. They break out, they pull back, and they trend. They break out, they pull back and reverse, and they break out, pull back, and just stay in a trading range. And again, every single day, one of those pairs falls into one of those 3 categories. So we want to identify the highest probability setups based on the high and low for either a trend trade or a stop hunt reversal trade. It's that simple. And that stop hunt reversal can end up being a trading range, but we want to target our 50 pips, keep it simple. We're going to go over the 6 key ingredients that outline trading success in your trading plan. We hit all of these with our simple 7-8 step routine for 50 pips a day. Now, just to reiterate, I've had some people ask about trading other currency pairs. It doesn't matter. If the setups are there, trade them. So I've looked and I've looked at different people's charts, and again, like we had a few really strong trending pairs this week, the pound yen, the pound Swiss, the pound. In other cross rate pairs, for example, the Aussie yen, there's been some good setups on the Aussie yen that the same criteria apply to. If you're trading another instrument and the setup is there, it's perfect. We want to just look at the highest probability opportunities when they present. So I mainly follow the pound crosses because out of the 6 pairs, I usually find one of the best playbook setups that matches that or a variation of it in that 12 candle window. And the further you go and the longer you follow this, you'll recognize when they show up. And you'll also recognize when a chart set up just the way that it's evolved through Asia and Europe, that it just may not be an ideal candidate to even look at in the US session. So we look at round numbers. Most of these highs and lows will be working around the number levels, the quarters, 50s, and double zeros. There's always a stop hunt. Now, as we saw last night, they did the stop hunt in that second 3-hour window just prior to the US market 12 candle window. They went 1, 2, 3 to the high, engulfed it, pulled it back, dropped it back inside of the Europe-London 3-hour high-low, went sideways at the numbers, and continued that move down through the low of the day for more than 50 pip move. Price action entries. We want to see an engulfment either at the stop hunt or in that sideways consolidation after they've hit the stops, or a pin hammer. Sometimes you'll get both. You might get an engulfment and then a pin hammer right next to it for the entry candle just prior to the open of the equities markets, which again, 8 to 11 p.m. New York Eastern Standard Time for Asia, 2 to 5 a.m. Eastern Standard Time, and 8 to 11 a.m. New York Eastern Standard Time. I don't care what you read on Baby Pips or Forex Factor or anything else. I've been studying this long enough. There are entries outside of this window. As we saw again yesterday, you could have traded the engulfment at the stop hunt at the high of the day. But these timings are when things will definitely be happening because the equity markets open in that middle hour. Risk reward, we want to be targeting, ideally a 50 pip range. And because if you're going to be risking 15 to 20 pips, you want to be targeting at least that 50. And as we saw with some of the structure and the high-low settings, some of those moves, even on the move long on the pound New Zealand, pound Aussie, they had already exceeded their ADR. The move back to the high of the day was over 75 pips. So if you get an opportunity to get more out of a winning trade, just keep getting better at trying to squeeze as much out of your winners and then keeping your losses tight and as small as possible. Then the next stage is managing yourself and managing the trade. So managing yourself can be difficult because you're sitting there for this 3-hour window, maybe 2-hour window, and just to go back over that, in 80% or more of the cases, if that first hour is the trap, stop hunt trap, really we've just narrowed it down to an 8 candle window. Now again, as we saw last night, we saw that stop hunt occur in the hour just prior to the 12 candle US window on a couple of the pairs, but we also saw the trap and stop hunt in the first hour in a couple of the other pairs for the second hour trade setup through the highs of the day in the US session, pound yen. But just want to re-emphasize 12 candles, 12 15-minute candles, and that's really important. But when you're trading it in live time, you might get impatient. You might not want to wait for the candle to close, and as you've followed longer, you realize that they will hang a candle around a level, a 15-minute candle, and literally in the last 30 seconds shift it back 7 or 8 pips, which changed the whole dynamics of how that candle pattern was presenting when they had it in the other direction. So very important to step back, be patient, know what you're starting to look for. Is it a 3-push pattern into a low or a high? Have they put a pin to the high and gone sideways in a shift candle for a reversal trade? Calmly place your order into the market, or focus on the number level, or put your order in at market, take the trade with your stop loss at the extreme on either side for roughly 1 ATR, 1 bar. Some trades might be a bit more than that, but you want to be targeting that risk reward that gives you that opportunity to extract as much as you can out of a winning trade. 6 ingredients for trading success. A method for identifying trades. We have that. Structure and high and low of the day. When the high or low gets violated, it's got our attention. We talked about previous days' high and lows being broken. That market has my attention now. There's a high probability that that market will either continue later in the session for a trend trade, breakout, pullback, continuation, or we may get a trade off the high or the low, either into the Europe Open or into the London session. So we have our method for identifying our trade setups. A method for entry. We talk about engulfments, pin hammers. Okay? Now, just to reinforce the importance of timings in your head. Now, There's not a lot of science fiction about this. The high and the low, the 12 candle window, we've just narrowed our opportunity down to a 3-hour window in a session. And we can only work off the high and the low. We talk about the hourly rotation, where most of those opportunities will come in the first or last candle of an hour. So now we've kind of narrowed it down to 6 bars. Think simple. A method to establish our initial stop loss. We talk about a 1-bar stop. And again, that may be, you might get in and there might be 3 bars there, but if your stop is at the high of the day, you're entering in near the high for a sell or a continuation, it's a 1-bar stop underneath the low or above the high. That's how simple it is. A method for taking profits. We know that we target 50 pips a day. Now, as you get better with this, start looking at the bigger structure and saying, oh, this could be a measured move. This could be a 100 pip trade. I know one trader took 100 pips on the pound Aussie yesterday. Perfect. He saw the opportunity. He recognized that it was going to be a measured move. But in the beginning, start looking at 50 pips. If it hits the high of the day at 40 and goes sideways, take 40. Just master the skill of taking profits off the table. Money management. Percentage risk. Are you trading correlated markets? Or are you trading into major news events? Okay, so I will identify a percentage of risk per trade. I don't like to take a bunch of trades at any one time. I'll focus on one trade setup. So I'm not worried about trading correlated markets. Primarily, I'm just looking at trading one good setup. And I don't get in front of news, but I will often, if I am in a trade prior, knowing that there's a news release in 2 hours and I'm in a trade, or there's a major news coming, I will look to either exit the trade, especially if it's BOE, the Fed, payrolls, any of those, or look at the bigger setup to know perhaps if that's a catalyst for a completion of the move. So often those news releases will be a catalyst to carry the momentum forward of an existing position that may be in the market. So hopefully that makes sense. Patience and discipline. Now, I've been guilty of violating both of those, but that's partly why we simplify things down, narrow it down, try to cut out all the variables and make it so simple that it's hard for you to screw it up. Now, if you're impatient, what's going to happen is eventually you're going to do damage to yourself, to your account, and then you're going to come back. And then when you do that enough times over and over again, you either go away and quit trading altogether, you blow up financially, or eventually you figure out ways to get past all that so that you can focus on mastering the process and let the profit side of things take care of itself. Build it up through your expertise and your discipline and patience to just execute day in and day out. So when people say to me this is science fiction and fairy tale, no problem. I can guarantee you they'll be talking about the same stuff in a year. If you do this, and it doesn't matter how you trade. You can use EMAs, you can use some kind of systematic approach with indicators or crossovers. It doesn't matter if it works for you. You have to personalize that and then get it into a simplified process that you can execute and duplicate day in and day out and scale it up in size. The idea is not to try and scalp pips and hit every move in the market. I want to identify my best buy setups, my best sell setups, and my trend setups, and then keep it simple. Keep looking for those setups, and when they show up, bump size up, get it bigger, keep getting it bigger, and eventually your trading size, you don't need to chase garbage. You get to that space where you're just stepping back and letting the market set up because you know there's enough of those opportunities that show up every single week. And you've been following me for long enough, there are 50 pips a day, and in often cases twice a day. So be patient, master your craft. Our system meets all the 6 key ingredients for trading success. So just keep mastering your craft, keep getting better. We're going to look at some examples of yesterday's, just looking at some simple setups, how some of them moved, how some of them were less than optimal, but just sticking to our basics, structure, high and low of the day, timings, round numbers, stop, hunt, trap, trade. Keep it simple, traders, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Just continuing our discussion on ingredients for success and the 6 components of a successful trading approach. And we talk about, structure. We talk about the high and low of the day we talk about the timings and the 12 candle window, and we talk about round numbers, risk reward, 1 bar stop, and just going to go over the basics again and just reiterate, keeping the same systematic approach each day. People have asked a lot of questions, and we can narrow this down pretty much even to 8 candles, because in the majority of cases, that first hour is often a trap or a stop hunt or both. And so again, we come back and we mark off our highs and lows, and we're just going to go through all 6 pairs from Wednesday's trading from May 3rd. Nothing that can be argued about. We talk about marking off the previous day's high and low. The blue line is the previous day's high and low. Both for high and low. In Asia, the pound Swiss broke the high of the previous day before pulling back, and then pulling back inside of its new high and low for the Asian session. And we mark our lines off, high and low. We just draw that across, and you can change it at any point when that becomes a new high or low. And again, we work from the high and the low. And we come to our 12 candle window, and this pair in the Europe Open moves to the high of Asia, pinning back and forth. Obviously not an ideal setup in our 12 candle window. Pins to the high, pinning the low. No breakout or engulfment that's at the high or at the low. Market stays in the consolidation, heading into the US Open. In between, in that rollover, we get a 1 push, 2 push, 3 push pattern. If you're not sure what that is, go and look at your pound Swiss chart and take a look at your chart. That's a 3 push pattern. We get a new high, so we have a stop hunt through the high. Then we get a pullback prior to the US Open. So we've already had a 3 push pattern into the high. We redraw our high. We have higher lows, and we get a 1, 2, 3 pin to the high and a pullback engulfment coming off of the 25 quarter level prior to the US Open, and then a bull pin hammer. So we have pins to the top, an engulfment at the numbers, and then a bull pin hammer just prior to the New York Open. Traders may have shorted that break of that candle back towards the London lows, thinking it may go all the way to the low of the day, but then we get a pin consolidation at the bottom. And again, I'm not saying this is an ideal setup for our 50 pips, but I'm reiterating the point that we draw our highs and lows. We look for the setups at the high or the low after the stop hunt. This is not an ideal setup, but we work from the high and the low. If traders were sticking around towards the end of that 12 candle window, they may have went long, and again we can see stop hunt candle, consolidation with pins on the top. Looking at the pound Aussie, again we had a 100 pip move down in Asia. Traders may have traded that, but we come back before the Europe Open and we redraw our highs and lows. We have a market that has engulfed and reversed off of the bottom with a 1, 2, 3 and then gone into consolidation. And so we redraw our highs and lows in that range. They break the high, and so we readjust that. And we readjust our low. And we get a breakout in that first hour, a 1, 2, 3, but it's a breakout of that trading range. Sideways on top of the range, pin hammer, and then another bear pin hammer and a breakout candle at the end of the second hour, the London hour, for a shift candle, moving back towards the high of the day. Traders may have positioned themselves somewhere in this after the breakout with the break of the London hour, last candle of the hour, knowing that this London hour, again, we've talked about this, if the first hour is a trap trade, we'll expect that trade in the first or second candle. Now, this particular market broke out of the trading range and went sideways. Breakout, pullback, continuation. That market moved up over 100 pips. And again, took out the swing high of the first 3-hour window of the London session before going 1, 2, 3, stop hunting traders from the previous day's U.S. session short, and then pulling back inside of the peak of the 3-hour high. We've had a stop hunt to the high, a 1, 2, 3, an engulfment at the high. The ADR has been met or exceeded as we head into the U.S. session, so we've exceeded the average daily range. That market dropped back down, pulled back, and then pulled back down again inside. We've talked about shorting bull candles for a 1-bar stop in a strong trend, whether that's an uptrend or a downtrend. So we have our first hour, the stop hunt has already taken place. We have an engulfment, so we have a current existing trade already in place from the high of the day. 1, 2, 3 back into the range. A stop hunt back against the trend. A move down, another move back against the trend. 2 bull candles, opportunities. And then the candle prior to the U.S. Open is a bull candle pin, which was broken for a short. If traders didn't short it up top, once it came back inside of the range for a move back down towards the lows of the Europe London Open. Pound New Zealand. Again, we mark off our highs and lows similar to the Pound Aussie. This pair had a big move down right off the start in Asia and then pulled back into consolidation. You will see this setup. We've seen this setup show up a few times in the last few weeks as a buy low setup where they 1 push, 2 push, a 1, 2, 3 stop hunt to the high, and then a 1, 2, 3 down, stop hunting the low. So 3 pushes down against the move. And again, this is the 3rd candle of the 2nd hour. So this traps traders chasing the move short. They chase the engulfment short into the bottom of the day. You're selling low here. This pattern, you will see it again and again and again. This is out of my playbook. And then traders who were seeing this, they would have traded the break of the 1030 high candle. Well, I call that 1030 on my charts, but that's 345 New York Eastern Standard Time, the break of the 345 high candle for the engulfment. Now that is an example of where when on the close of the candle, traders may have been afraid to take that. Traders who saw that setting up in the end of the 2nd hour for the reversal would have traded the break, and that move went right back to the high of the day for almost 75 pips. We pull back inside again, inside the consolidation. So remember what we talk about, the high and the low. Then the market consolidates, trapping volume. Then it hits the stops, pulls back inside, consolidates again. 1, 2, 3 to the high, engulfment off the high of the day just prior to our U.S. session 12 candle window. So this is an example of where the stop hunt occurred prior to the market open. Comes back in. This is a stop hunt back in the range against traders who are long. It's a 1, 2, 3 down, pull back, continuation at the end of the 1st hour. So again, we can short the bull candle. Then the market goes sideways with an inside bar pin hammer at the beginning of the 2nd hour. The market pins down. Traders think this is going to be a reversal. They take the break of the high and then bang, they trap them, stop them out, and continue that move down. Now for people who aren't seeing these patterns set up, go back and review your charts. You're going to see the same things happening over and over again. Stop hunt to the consolidation, stop hunt to the high, shift candle, reversal. We'll look at the pound. Again, we had a big move up in Asia, 50 pips. We mark off our high. They pull it back into consolidation in the 2nd 3-hour window. We mark off our low. They go 3 pushes into the high of the Asian session, stop hunting traders who were short without taking out the high of the day. And then a big stop hunt shift candle getting traders who were long in that 2nd 3-hour window, pinning the stops. 1 push, 2 pushes, 3 pushes down with a stop hunt already intact. Traders inside of that next 3-hour window again. One of the reasons there are trade setups that take place in that second 3-hour window. But the name of the game is to trap volume inside, then hit the stops. 1, 2 down, pulls it back. In our second hour, stop hunt high in against the traders who were short, and then they pin the low one more time. So that's a stop hunt to the downside. Hit the stops, pull it back, shift the market to the high, hit the stops up top. Now again, not saying that you need to trade every move in this market, just demonstrating we work from the high and the low. But you'll see 1 push, 2 push, 3 pushes down, reversal, stop hunt the high of the day. Very tight consolidation. You're trading in a tight 25 pip box. Again, they make you chase the market. These pins on, you'll notice there's pins on the inside, and that's pinning traders who are short, holding on for the continuation. They don't go to break even because they can't, or if they did, they're stopped out. And then in one big candle, they hit the stops. Pound yen, same thing. We broke the previous day's high. Had a strong trending market. We go vertical for 50 pips right off the bat before coming back down. They make a high and a low. Then they pull the market back into consolidation. And in that second 3-hour window, they work it down. 1 push, 2 push, 3 push shift candle. Traders could have traded the beginning of the Europe Open in the 12 candle window. So this is no different than our US session or anything else. Stop hunt low, pull it back into consolidation, and then they're working it into the peak formation low. 1 push, 2 push, 3 pushes, engulfment candle. Traders taking this, perceiving that that trend will continue through the high of the day, but we get to the end of that first hour when London opens, and they're still not getting any higher. So we've been in that trade an hour and a half before they shift it back. Stop hunting traders who are long. Pin the stops, and again, 1 push down, 2 pushes down, 3 pushes down, back to the high of the day, hitting the stops, consolidation, stop hunt to the low of the day prior to the US session open, stop hunt back up in that first hour with pins on traders who are short, 1 push, 2 pushes, and then 1 push down, 2 push down, 3 pushes down, and the third push long is a 50 pip move back up. So you'll see the 2-bar reversal on the third push to the downside. Stop hunting traders who were long on the pin hammer right off the first candle of the 12-hour US session window. So if they'd gone to break even, they were stopped out at break even. If they waited for the reversal candle, they were long from the first candle. And if they were long on the second candle, the market hung around for 3 candles, just making them stress. But you can see again, the stop hunt was down, and the reversal candle, this is an example of a 4-bar reversal, not an engulfment, but an example of a very similar pattern where they use that sideways candle action to get traders to second guess their trade, shake them out of a possible profitable winning position before reversing for 50 pips to the high of the day and hitting the stops. So again, traders, we stick to the high and low of the day, basically looking for, are they working the high, are they working the low? We're looking for the ideal range to be established for at least a 50 pip move back to the high or to the low. After they've consolidated and went sideways with an engulfment or a pin hammer for the reversal or the continuation trade of a trend trade. So hopefully you got some value from today's video, traders. Keep it simple. It happens every single day. Look for the best setups on any instrument that you're trading for that range to be there, for the market to have hit the stops, consolidated, and given you the shift candle for the entry, either for the continuation or for the stop hunt back in the other direction. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburkeTrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.